Greg Towner here with Parallel Portfolios, and it's time for our September 5 charts in 5 minutes. So let's jump right into it. I'm actually recording this just a little bit after the big Fed meeting, and I say big because everybody's been waiting for it. Not too much of a surprise came out of it. We'll get into that more in a moment. But let's focus for the beginning here on the S&P 500. Looking back over the last couple of years or so, we always like to start off with this chart just to kind of give a little bit of perspective. And even though we're in this kind of traditionally weak seasonal period, stocks have ignored that and just kept moving higher recently to a new all-time high, at least on the S&P 500. I know a lot of times people get worried about, well, stocks have gone too far, too fast, or that sort of thing. Of course, they can always have pullbacks. That's a normal, healthy part of markets. But in general, you just really shouldn't fear strength in the market. New highs tend to be a positive looking out in the distance. And we'll get into that towards the end of this call. Let's also take a quick look at interest rates. This is the 10-year yield. After trading for the last, oh gosh, almost a year, around 4.5%, it's really started to dip of late, partly because of expectations of the Fed cutting, partly because some concerns about economic weakness and other factors. I mean, this is a negative if you are wanting to, say buy a bond or put money in a money market or something like that. But it's a positive if you are taking out a mortgage or some other kind of loan, or if you invest in companies that are taking out loans, that sort of thing. So kind of a mixed bag on rates, but currently on a little bit of a decline. So why is the Fed starting to cut rates, which they are? Well, they of course have a dual mandate where they're looking at the jobs market and at inflation. And with the recent revisions to some of the payrolls, job market payrolls, we can see here for the first time in 53 months, a negative jobs month, and the other months have been kind of weakening. So the Fed has finally decided, hey, we're a little bit concerned about inflation still, no doubt, but the jobs market is enough where, hey, we kind of have to at least kind of hedge our bets, so to speak, and start to cut rates a little bit. But this is why it's been a difficult position for them. This is a survey that Bank of America has done. This goes back 25 years of fund managers and what they're expecting in a couple of categories. The dark blue line here is the expectations for if short-term rates will move higher in the future. So they're not. They're expecting rates to stay, the same or go down. And the light blue line is if they're expecting inflation to move up, and they are. You can see historically this kind of was very highly correlated, but now people are concerned that inflation could be moving higher, but the rates would be not. And this is the difficulty that the Fed finds themselves in. They keep saying that they think that this current inflation that is incurring is just tariff related and a one-time thing. Hopefully that's the case. But nonetheless, this is why they're probably not moving more aggressively on cutting interest rates than they are so far. Well, there's definitely some positive things happening out there. And since the whole tariff scare, I guess you could call it, that scared the market back in April, stocks have been ripping higher for the last 5 months or so. If we go back to 1950 in the S&P 500, and we look at similar periods where stocks moved that much in just a 5-month period, and we look at the average returns going forward and how frequently the market is up, 1 month out, pretty typical, returns, nothing to, be too surprised about. But as you go out 3, 6, and 12 months, the frequency of positive returns is much higher than just any other period. And the average and median returns for the market is significantly higher than any other period. And so think back to what I said at that first chart when I showed the S&P 500 right now, and I said, hey, don't fear strength. Stocks, strength in stocks, new highs in stocks tend to be positive looking out 3, 6, 12 months. I mean, yes, there can always be pullbacks. That's part of investing, but don't fear strength. Well, in sum, yes, the Fed is starting to cut rates. They'll probably do a couple more this year. We'll see about next year. It's too early to say for that for sure. There's a lot of cash on the sidelines, a lot of money sitting in money markets, earning their, 4% or so and thinking that they're happy with that, even though, frankly, it's getting eaten up by inflation. But as those rates are coming down on cash, you're probably going to see more and more people say, maybe it's not worth it to keep it there. Maybe I'll start to invest since, stock trends are positive. So if you need help with that, you of course know where to reach out to us and we'd be happy to help. So until next time, thank you for joining us.